Welcome to the Deep Dive, the show that cuts through the noise to get you the most important insights on topics that really matter.
Thanks for having me.
Today we're tackling, well, a universal dream, right? Home ownership. But it often comes with this really overwhelming question. Where do I even begin?
Yeah, absolutely. Especially for first-time home buyers, there's just a vast ocean of information out there.
Totally. It can feel paralyzing.
It really can. So our mission with this deep dive is to be your shortcut, essentially.
Right.
We've sifted through a whole stack of sources, consumer guides from the National Association of Realtors, financial stuff from places like Navy Federal Credit Union and Rocket Mortgage, even a state guide from New Jersey's Department of Banking and Insurance, plus current market predictions from Forbes.
Right. So we're pulling from a lot of solid places.
Exactly. The goal is simple. Extract the really important nuggets, give you clarity, give you confidence for, what's a massive life decision?
Yeah, for sure. So we'll unpack the money side, demystify mortgages, talk about the house hunt.
And yeah, every step from making that offer right through to getting the keys in your hand.
All right, let's dive in then.
Let's do it.
Okay, so I think when most people think home ownership, their mind jumps straight to the mortgage payment. It's the big number.
Naturally.
But before you even start dreaming, scrolling through listings online, what are those other costs? The hidden financial realities people need to brace for.
That's such a crucial point. It's easy to fixate on just the loan itself, the principal and interest.
Right.
But you've got to think bigger. There are property taxes, which vary a lot by location. There's mortgage insurance, if you need it. Homeowner's insurance, definitely.
Okay.
And then utilities, electric, gas, water, trash, those add up.
And maintenance, right. I hear that's a big one.
Oh, yeah. Maintenance is key. A good rule of thumb. Plan for about 1% of the home's purchase price annually just for general upkeep.
1% annually. Wow.
And that's separate from potential repairs for unexpected stuff, like the water heater suddenly dying.
Ugh.
And if you're in a community with one, homeowner association dues, HOA fees, those average maybe $200, $300 a month, but honestly, they can range from like $100 up to $1,000 sometimes.
Jeez. Okay, so it really adds up.
It does. The key insight here really is understanding your total monthly income versus all your non-housing expenses. That helps you figure out your actual available budget for housing.
Got it. So you know what you can truly afford each month.
Exactly. You want to avoid that scenario where your estimated total housing expenses blow past that comfort zone you figured out.
Okay, so it's a whole financial ecosystem, not just one payment. Is there one cost there that tends to blindside people the most?
I'd say, yeah, definitely the maintenance and the unexpected repairs.
Really?
Yeah. Most first-timers, they budget really carefully for the mortgage itself, but they just underestimate how fast little things, or sometimes big things, add up. That 1% rule. If you don't account for it, your dream home can become a bit of a budget nightmare.
Oof, I can see that. Okay, let's talk down payment then. This feels like, I don't know, a mythical beast to a lot of people. What's the actual range we're talking about?
Right, the big upfront hurdle. Well, typically down payments range from 3% to 20% of the purchase price.
3 to 20%.
Yeah. For first-time buyers, though, the average we see is usually around 7%.
Okay, 7%.
And it's important to remember, the more you can put down, generally the lower your monthly mortgage payments will be.
Makes sense.
And there are loans like FHA loans, which can allow a down payment as low as 3.5%.
3.5%? That's quite low.
It is. So for example, on a $200,000 home, 3.5% down is $7,000, whereas 7% down would be $14,000.
Man.
Now, if you put down less than 20%, you'll usually have to pay PMI, private mortgage insurance.
Right, PMI. What's that for again?
It protects the lender, not you, basically, if you default on the loan. The good news, though, is that PMI isn't usually permanent. It can typically be canceled once your loan-to-value ratio hits 78% of the home's original value.
Okay, so once you've paid down enough of the loan.
Exactly, you build up that equity.
Now that down payment, even at 3.5% or 7%, it feels like this huge hurdle for so many people. It's the biggest upfront cash need, right?
Absolutely. It's often the main barrier.
But here's something really powerful, kind of a secret weapon that a lot of first-time buyers might not know about. There are actually programs designed to help with that lump sum.
That's absolutely right. And there are quite a few options out there.
Like what?
Well, many states, counties, even cities offer down payment assistance programs, DPA programs.
Okay.
These can be grants, which you don't have to repay, or maybe low-interest second loans, or even tax credits to help cover or offset those costs.
That can make a huge difference.
It really can. And another thing is down payment gifts.
Yeah.
You can potentially receive help from family or close friends.
Oh, okay. Can you just take cash?
Well, lenders will need documentation. They want to see it's a true gift, no expectation of repayment. This is partly to prevent, disguised loans or money laundering issues.
Really, paperwork.
Yeah, they'll want a clear paper trail. Things like bank statements showing the funds leaving the giver's account or maybe a cashier's check.
Okay, that's really good to know about the assistance and the gift rules. Fantastic insight.
Yeah.
Next up, something lenders definitely zoom in on, your debt-to-income ratio, or DTI. How does that fit in?
DTI is huge for lenders. It measures how much of your gross monthly income, that's your income, before taxes and deductions, goes toward paying your recurring monthly debts.
Okay, how do you figure it out?
You just divide your total monthly debt payments, things like student loans, car payments, credit card minimums, by your gross monthly income.
Almost a good number.
Generally, a DTI of 36% or lower is considered healthy. Many lenders get hesitant if your DTI, including the new potential mortgage payment, would push past 43%.
Why 43%?
It's just seen as a higher risk threshold. So, quick example. Say you have $700 in existing monthly debt payments. Your gross monthly income is $4,500, and your potential new mortgage payment is estimated at $1,000. Your total monthly debt would be $1,700. Divide that by $4,500, and your DTI is about 37.7%.
So just over that 36% ideal mark, but under 43%.
Exactly. Manageable. But, reducing existing debt before applying, or maybe looking at a slightly less expensive house to lower that potential mortgage payment, that could definitely help you secure better financing terms.
Right. So how does all this financial stuff, the DTI, the savings, how does it translate into your credit score, and why is that score so critical?
Your creditworthiness, basically your credit score, has a direct and frankly significant impact on the interest rate and the loan terms you'll get.
Okay.
Lenders use scores like the FICO score. Generally, you'll want a score of 620 or higher to qualify for most conventional mortgages.
620 minimum, generally.
Yeah. Now, for FHA loans, the rules are a bit different. If your score is 579 or lower, you'll likely need a 10% down payment. But if it's 580 or higher, you could potentially qualify with just that 3.5% down we talked about.
Big difference. So how do you improve your credit if it's not quite there?
It takes time, but focus on consistency. Consistent employment is good. Lenders like to see maybe 2 or 3 years at the same job or in the same field. Always make your payments on time, every time. Keep your outstanding debt balances low, especially on credit cards. And having some money in a savings account shows financial stability.
And checking your report is important too, right?
Absolutely crucial. You should review all 3 of your credit reports from Experian, Equifax, and TransUnion every year. You can get them for free once a year at annualcreditreport.com.
Annualcreditreport.com. Okay.
Yeah. Look for any errors or inaccuracies. If you find something wrong, dispute it immediately. Those errors can seriously drag down your score.
Yeah, definitely. And here's a pro tip we pulled from the sources. The difference between having just okay credit and good or excellent credit, it can literally cost you tens of thousands of dollars more in interest over the life of your loan.
It's staggering, but true. Getting your credit in the best possible shape before you even start seriously looking or applying for a mortgage, it's probably one of the smartest financial moves you can make in this whole process.
Absolutely. Okay, so financial house is getting in order. You've got a handle on your budget. Maybe you've even started working on your credit. The next huge piece of this puzzle clicks in, the mortgage itself.
Right. Securing the actual loan.
And this is where things can feel, I don't know, really overwhelming again. So many options, so much jargon.
It absolutely can feel that way. But understanding the main types of loans available and also a really critical distinction between pre-qualification and pre-approval, that's key to navigating this confidently.
Okay, let's break it down. Start with the different flavors of mortgages. What are the main types a first-time buyer needs to know about?
Sure. So the most common type is a conventional loan. These aren't directly backed by the government, but they have to follow guidelines set by Fannie Mae and Freddie Mac.
Okay.
Yeah, they're government-sponsored enterprises that buy mortgages, so they set the standards for a lot of the market. And then you have jumbo loans.
Jumbo. Sounds big.
Yep. They're for loan amounts that exceed those conventional limits set by Fannie and Freddie. Right now, that's generally over $726,200 in most parts of the country, though it can be higher in expensive areas. They're seen as a bit riskier for lenders.
Okay. And then there are government-backed ones.
Right. Several key ones. FHA loans, which are insured by the Federal Housing Administration, they often have easier credit requirements and lower down payment options, like that 3.5%. Great for some first-time buyers.
Mm-hmm.
VA loans, backed by the Department of Veterans Affairs, these are fantastic if you're eligible active military, veterans, some spouses. Often 0% down payment required, no PMI, and usually better interest rates.
Wow, 0 down.
Yeah. And then USDA loans from the Department of Agriculture. These are also potentially 0 down, but they're specifically for eligible rural and sometimes suburban areas, often come with lower rates too. So the key is figuring out which program, if any, you might qualify for and benefit from.
So many paths. And
Yeah.
then within these loans, you also have the choice between fixed rate and adjustable rate, right?
Yeah.
That feels like a pretty fundamental decision.
It really is. A fixed rate mortgage, or FRM, is just what it sounds like. Your interest rate is locked in for the entire life of the loan, whether that's 15 years, 30 years, whatever. So your principal and interest payment never changes.
Predictable.
Very predictable. That's why about 90% of home buyers go for fixed rate mortgages, especially the 30-year fixed.
Right.
Now, an adjustable rate mortgage, or ARM,
The rate adjusts.
exactly. You usually get a lower initial interest rate for a set period, maybe 5, 7, or 10 years. But after that, the rate adjusts based on market conditions, maybe annually.
So your payment could go up or down.
Or down, theoretically. But historically, rates tend to go up over long periods. ARMs can be okay if you know you're only going to be in the home for a few years, maybe less than the fixed period. But there's a risk called negative amortization.
What's that?
That's when your adjusted payment isn't even enough to cover the interest that's accrued, so your actual loan balance starts increasing. It's rare, but a serious risk to be aware of with some ARMs.
Yikes. Okay. And what about rate locks?
Ah, yes, a rate lock. When you find a rate you like, your lender can lock it for you for a specific period, say 30, 60, maybe 90 days, while your loan is processed. This protects you if rates go up before you close.
But what if rates go down?
That's the downside. If rates drop significantly during your lock period, you might miss out on that lower rate. Some lenders offer a float-down option, but it might cost extra.
Okay, lots to consider there. Now, you mentioned something earlier, pre-qualification versus pre-approval. This is a key aha moment for a lot of buyers, right? They sound so similar.
They do, but they are worlds apart in terms of what they mean. It's a huge point of confusion.
So break it down for us. Pre-qualification.
Pre-qualification is really just a quick, rough estimate. It's usually based on financial information you provide yourself, income, debts, assets without much or any verification. It often involves a soft credit check, which doesn't hurt your credit score.
So it gives you a ballpark idea.
Exactly. A ballpark idea of how much you might be able to borrow. It's helpful for setting an initial budget, maybe early in your search, but it carries very little weight with sellers.
Okay. And pre-approval.
Pre-approval is much more serious. This is where the lender digs deep. They'll ask for and verify your documentation, tax returns, pay stubs, bank statements, employment history. They'll also do a hard credit check, pulling your full credit report.
Which does impact your score slightly.
It does, usually a small temporary dip. Based on all that verified info, the lender gives you a conditional commitment for a specific loan amount at a specific interest rate range, usually valid for about 60 to 90 days.
Okay, so it's a real verified assessment. Why is that pre-approval so much more crucial than just pre-qualification?
Because that pre-approval letter is gold when you're making an offer. It shows sellers you're not just window shopping. You're a serious, qualified buyer who has already gone through the lender's initial vetting process.
It gives you credibility.
Huge credibility. It enhances trust, gives you much stronger negotiating power, especially in a competitive market, and it can really streamline the whole closing process because a lot of the financial legwork is already done.
I can see how a seller would prefer an offer from someone pre-approved.
Absolutely. Imagine you're a seller with two similar offers. One has a pre-approval letter, the other of just a pre-qualification or nothing. Which one feels safer?
The pre-approved one, definitely.
Exactly. And here's a helpful tip about shopping around. Getting multiple pre-approvals to compare offers. If you do it within a relatively short window, usually around 45 days, the credit bureaus typically count those multiple hard inquiries as just one single inquiry for scoring purposes.
Oh, that's good to know. So you can shop around without wrecking your score.
Yes, within that window. So it's smart to compare offers from a few different lenders.
Okay, that is powerful. So, summing up this part, our pro tip is crystal clear. Get pre-approved, Do it early. Use a strong, reputable lender. It clarifies your budget, proves you're serious to sellers, and just strengthens your whole position.
Couldn't have said it better myself. It's a non-negotiable step for serious
All
buyers.
right. Finances checked, pre-approval, hopefully in hand. Now the really exciting part can begin, actually finding that dream home.
Yes, the house hunt.
But before you start hitting those open houses or scrolling endlessly online, let's talk about who you want guiding you through this. A real estate agent.
Choosing the right agent is, incredibly important. Think of them as your advocate, your guide, your liaison through this whole complex maze.
What exactly do they do for a buyer?
A lot. They help you find listings that match your criteria, schedule and accompany you on showings, get answers to your questions about specific properties, draft and deliver your official offers, handle counteroffers back and forth.
Okay, the negotiation part.
Yes. They also provide guidance on navigating home inspections and help troubleshoot any obstacles or issues that pop up along the way, right up to closing.
And here's something that still surprises a lot of first-time buyers, isn't it? Who pays the agent?
Right. This is key. In most transactions, the seller pays the commission for both their listing agent and the buyer's agent.
So as the buyer, getting that expert representation is usually free.
Essentially, yes. It comes out of the seller's proceeds from the sale. So there's really no reason not to have your own dedicated agent working for you.
That's huge. Now, I've heard the term realtor versus real estate agent. Is there a difference?
There is. All realtors are licensed real estate agents, but not all agents are realtors. A realtor is a member of the National Association of Realtors and pledges to adhere to a strict code of ethics.
So maybe an extra layer of professionalism or accountability?
That's the idea behind it, yes.
Okay. Now, here's an important question that sometimes comes up. What about dual agency, where one agent tries to represent both the buyer and the seller in the same deal? That sounds tricky.
It is tricky, and it's definitely a potential red flag. Dual agency is actually illegal in some states precisely because of the inherent conflict of interest.
How can one person truly represent both sides' best interests?
Exactly. It's almost impossible. In states where it is allowed, the agent must disclose it very clearly to both parties. Honestly, most experts advise against it. You really want an agent who is 100% advocating for you.
Makes sense. So when you're vetting potential agents, what should you look for?
Look for someone with strong local market knowledge. Experience, especially with first-time buyers, if that's you. Ask about their success rate, how they communicate. You want someone you click with and trust.
Good advice. Okay, agent selected. Now, thinking about the actual house, it's easy to get caught up in aesthetics, right? What looks good on Instagram or Pinterest.
Totally. Happens all the time.
But it's really about what functions for you day in and day out.
Precisely. We strongly recommend creating a home buyer's checklist. Sit down and really think about your must-haves versus your nice-to-haves.
Like what?
Minimum number of bedrooms and bathrooms. A specific architectural style you prefer, maybe. The neighborhood location is huge, your firm price range, obviously. And specific features, maybe you absolutely need a fenced yard for a dog or a dedicated home office space.
So get clear on priorities.
Yes, but also build in some flexibility. Your absolute perfect dream home might not exist or might be just out of reach financially. Be prepared to make some compromises, especially on the nice-to-haves.
Okay. Now, you're at a showing. You walk into a house. What should you be laser focused on beyond the seller's nice furniture or fresh paint? What are the real things to look for or look out for?
Right. Try to see past the staging, focus on the bones of the house, the fundamental structure and layout. Look closely at walls, floors, ceilings, windows.
What are some big red flags? Things that scream expensive fix.
Uneven floors or significant cracks in walls or foundations could mean foundation issues. Big problem. Sagging or damaged roof shingles. And obviously, ancient HVAC system or water heater, those are costly replacements.
All right. Windows.
Foggy double-paned windows where the seal has failed, or cracked panes. Look for signs of termite damage, like mud tubes or damaged wood, widespread water stains on ceilings or walls.
Also damage, yeah.
Also, consider the property itself. Is it very close to a body of water? Check flood maps. And be a little wary if a house has been on the market for a really long time, or if it's had offers fall through, often means an inspector found something significant.
Good points.
And functionally.
Check the basics. Are there enough electrical outlets where you'd need them? Does the lighting seem adequate? Turn on taps, check the water pressure. Open and close doors and windows, check the locks. Does the space actually feel big enough for your needs?
Gotcha. And here's a little pro tip we found. When you're at the showing, be polite, be respectful, but maybe try not to gush too much about how much you love the place, especially if the listing agent is there. Huh, yes. Keep your poker face on. You don't want to give away too much leverage before you even make an offer. Save the enthusiasm for your own agent later.
Good tip.
Yeah.
Okay, so you found the one, or at least the one you want to make an offer on. What's actually in that offer document?
Your offer to purchase, sometimes called a purchase agreement, is the formal legal document. It outlines the price you're offering, obviously. It includes the amount of earnest money you're putting down.
Earnest money? What's that?
It's basically a good faith deposit, shows the seller you're serious. It's typically 1% to 3% of the purchase price.
Okay, 1 to 3%. And when do you pay that?
Usually within a few days, often 3 days of your offer being officially accepted by the seller.
And where does that money go?
It's held in a neutral third-party account called an escrow account, usually managed by a title company or lawyer. It's not given directly to the seller yet. And if the sale goes through, that money gets applied towards your down payment and closing costs.
Got it. What else is in the offer?
Your desired closing date when you actually want to take ownership. And, crucially, any contingencies.
We'll come back to those. Now, here's a weird one I've heard about. Stigmatized properties. You know, houses where maybe there was a famous crime or people think it's haunted. Is that something sellers have to tell you about?
That's an interesting niche area. Generally, no. Sellers and their agents usually aren't obligated to proactively disclose things like alleged hauntings or past events like a death on the property, unless it was maybe related to a physical defect.
So they don't have to volunteer it.
Correct. However, if you specifically ask them, was there ever a death in this house? Or are you aware of any reports of paranormal activity? And they do have knowledge of it, then they generally are obligated to answer truthfully. Disclosure laws vary a bit by state on this.
Fascinating. Okay, so you submit your offer. What happens then?
The seller has 3 basic options. 1, they can just reject your offer outright. 2, they can accept it exactly as it is. If they do that, congratulations, you are officially under contract.
Deciding.
Yeah.
And option 3.
Option 3 is they can make a counteroffer. They might agree to some terms, but want to change others, like the price or the closing date, or maybe remove a contingency. This kicks off the negotiation process back and forth between you and the seller, usually via your agents.
Okay, now, back to those contingencies you mentioned. They sound important, like safety nets.
Exactly. Contingencies are conditions written into your offer that must be met for the sale to proceed. They are your protection, allowing you to legally back out of the deal and get your earnest money back if something goes wrong.
What are the common ones?
The big ones are usually a financing contingency, meaning the deal depends on you actually securing the mortgage. A home inspection contingency gives you time to have the home professionally inspected and potentially renegotiate or withdraw based on the findings. And an appraisal contingency ensures the home appraises for at least the purchase price, protecting you and the lender.
So they let you walk away if the loan falls through, the inspection finds huge problems, or the house isn't worth what you offered.
Precisely. You also always want to ensure you have the right to a final walkthrough just before closing. This is your last chance to check that the property is in the agreed-upon condition, any required repairs were made, and the seller has fully moved out.
Okay. Is there anything tricky with dates in the offer?
Yes. Be aware of a time is of the essence clause, sometimes abbreviated TOT. If this is included for the closing date, it means that date is firm and non-negotiable. Missing it, even by a day, could potentially lead to penalties or void the contract. So you and your agent need to be very confident you can meet that deadline if you agree to a T-out clause.
Good to know. Approach TOT with caution.
Definitely.
All right, huge progress. You found the house, navigated the offer and counteroffers. Your offer is accepted, contingencies are in place, you're under contract. Feels like you're almost there, but what's next?
You're on the home stretch, but yes, there are still some critical steps. Now we move into the post-offer phase. Appraisal, inspections, title work, the lender's final underwriting, and then finally the closing itself.
Okay, let's tackle appraisal and inspection first. They sound kind of similar, someone looking at the house, but they serve different purposes, right?
Very different purposes, yes. The appraisal is primarily for the benefit of your lender.
For the lender, okay.
Yeah. They hire a licensed appraiser to give an independent, professional opinion of the home's fair market value. They need to make sure the property is actually worth the amount they're lending you.
How do they figure that out?
Appraisers mainly use comparables or comps. They look at recent sales data for similar homes in the same neighborhood, similar size, age, condition, Features usually pulling data from the multiple listing service, the MLS.
And who pays for the appraisal?
The buyer almost always pays for the appraisal. It typically costs somewhere in the $300 to $600 range, maybe more for complex properties.
Okay. And what happens if the appraisal comes in lower than the price you agreed to pay?
That can be a major issue. It's called an appraisal gap. If the home appraises low, the lender will typically only lend based on the appraised value, not the higher purchase price. This means you might have to come up with extra cash to cover that difference yourself, try to renegotiate the price down with the seller, or if you have an appraisal contingency, you might be able to walk away from the deal.
Wow. Okay. So the appraisal is key for the loan value.
Yeah.
What about the home inspection then? That sounds like it's more for the buyer's benefit.
Exactly right. The home inspection is highly, highly recommended, and it's for your peace of mind and protection. You hire your own licensed home inspector.
And what do they check?
They do a thorough visual examination of the home's major systems and components. We're talking the roof, foundation, structure, exterior, interior plumbing system, electrical system, heating and cooling, HVAC, pretty much everything accessible.
And what do you get out of it?
You get a detailed written report outlining everything they observed, including any potential problems or areas needing maintenance or repair, often with photos. This report is invaluable. Based on the findings, you might ask the seller to make specific repairs, or ask for a credit towards closing costs, or even renegotiate the purchase price. If the inspection reveals major deal-breaker issues, your inspection contingency allows you to withdraw from the purchase.
How much does an inspection usually cost?
Generally, somewhere between $200 and $400, maybe a bit more depending on the size and age of the house. Worth every penny.
Absolutely. Are there other specific checks people should consider?
Yes, depending on the house and location. For homes built before 1978, a lead paint inspection is wise. You might also consider tests for toxic mold, radon gas, which is common in many areas, asbestos in older homes, or even checking for things like off-site conditions, nearby construction, landfills, that sort of thing.
Okay, so inspection's done. Next up, title and escrow. This starts to sound like pure legalese for a first-timer.
It can seem that way, but it's all about ensuring clear ownership. A title search is performed, usually by a title company or an attorney.
What are they searching for?
They're searching public records to verify that the seller legally owns the property and has the right to sell it. They're also looking for any claims or liens against the property, like unpaid property taxes, judgments from lawsuits, outstanding mortgages, mechanics liens, that kind of thing. Anything that could cloud the title.
So making sure the seller can actually sell it cleanly.
Exactly. And to protect against any hidden issues that the search might miss, you get title insurance.
Insurance for the title.
Yep. There's usually a policy for the lender, lender's title insurance, and one for you, owner's title insurance. It's typically a one-time fee paid at closing, and it protects both you and the lender if some unknown ownership claim or title defect pops up after you buy the house.
Okay, that sounds important. And escrow. You mentioned that earlier with earnest money.
Right. The escrow account is managed by that neutral third party, the escrow agent, often the title company. They hold all the important documents and funds related to the transaction, like your earnest money deposit, loan documents, the deed, etc. They only release everything and finalize the transfer of ownership once all conditions of the sale contract have been met by both buyer and seller. It ensures a secure and orderly closing.
Got it. So title's clear, escrow's handling the funds. Now comes the lender's final step, right?
Underwriting. Sounds intense.
It is the lender's final deep dive into your finances to give the ultimate green light on the loan.
The final boss battle.
Kind of. The underwriter meticulously reviews all the financial and personal documentation you've submitted, income verification, assets, debt, credit report, appraisal report, title search results, everything.
They might ask for more stuff.
Oh, yes. It's common for underwriters to request additional documents, updated pay stubs or bank statements, or letters of explanation for anything unusual they find in your file. They might also send you revised loan estimates if anything changes.
What's the goal here? The goal is to get that coveted clear-to-close notice. That means the underwriter is satisfied, all conditions have been met, and the lender has fully approved your mortgage and is ready to fund the loan.
Okay. And there were some big don'ts during this underwriting period, right?
Absolutely critical. This is the time to basically freeze your financial life. The big mortgage do's and don'ts really apply here. Don't change jobs. Don't make any large purchases, especially on credit like buying a car or furniture for the new house yet. Don't apply for new credit cards or loans. Don't move large sums of money around between accounts without talking to your lender first. Don't co-sign on a loan for anyone else.
Why not?
Any significant change to your income, debt, assets, or credit profile during underwriting can raise red flags, potentially delay your closing, or even cause the lender to withdraw your loan approval entirely.
Wow. So just sit tight financially until after closing.
Exactly. Keep everything stable and boring until you have the keys.
All right. Underwriting is complete. You got the clear to close. Now it's really happening. The big day.
Yeah.
Closing.
The finish line.
What happens right before and during closing?
First, typically the day before or the morning of closing, you'll do your final walkthrough of the property.
Why is that so important?
It's your last chance to confirm that the seller has completely moved out, that any agreed-upon repairs have actually been completed satisfactorily, and that the property is in the condition you expected, no new damage, systems are working, etc. If you find issues, you address them before signing the final papers.
Okay. And then the actual closing appointment.
You'll have received your closing disclosure, or CD, from your lender at least 3 business days before closing. Review this document incredibly carefully. It outlines all the final official terms of your loan interest rate, monthly payment, and crucially, the exact amount of cash you need to bring to closing for your down payment balance and closing costs. Compare it closely to the loan estimate you received earlier.
Got it. Review the CD carefully. Who's usually at the closing table?
It can feel like a crowd. Usually you, the buyer, possibly the seller, though sometimes they pre-sign, your real estate agent, the seller's agent, maybe attorneys for both sides, a representative from the title or escrow company, and sometimes a representative from the mortgage lender.
And then?
Paperwork.
Oh, yes. Expect a veritable mountain of paperwork to sign. Be prepared. Maybe bring water. It can take an hour or two.
What are the key documents you're signing?
Some of the most important ones include the mortgage note or promissory note, which is your formal promise to repay the loan amount according to the agreed terms. The mortgage deed or deed of trust, which pledges the property as security for the loan. Your initial escrow disclosure statement detailing how much will be collected monthly for property taxes and homeowners insurance, the title insurance commitment. And the big one, the deed, which is the legal document that officially transfers ownership of the property from the seller to you.
Okay, you sign and sign and sign.
You sign and sign. Funds are exchanged.
Then the moment you've been waiting for. Exactly. Once everything is signed, verified, and funds are confirmed, the title representative will record the deed and you'll be handed the keys to your new home. You walk out an official homeowner.
Amazing. Such a huge milestone. But the journey doesn't quite end there, does it? Now you actually have to move in and be a homeowner.
Indeed. The adventure continues. We definitely recommend having a practical moving checklist. Things like setting up mail forwarding with the post office well in advance, arranging to transfer utilities, gas, electric, water, internet into your name effective on your closing or move-in date.
Good point about utilities.
Decluttering before you pack makes moving so much easier. Pack an essentials box with things you'll need immediately on day one: toiletries, medications, basic tools, phone chargers, snacks, toilet paper, and keep important documents like closing papers somewhere secure and accessible.
Any tips for the actual move to make it less chaotic?
If you have a gap between closing and needing to be out of your old place, use that time to deep clean or paint the new house while it's empty. It's so much easier. Plan your move early. Get quotes if using movers. Label your boxes thoroughly with the room they go to and a general idea of contents. Scout the route, especially if driving a big truck.
And maybe plan for that first night.
Oh, absolutely. Order takeout. Don't plan on cooking. And if you have young children or pets, arranging care for them on the actual moving day can reduce stress immensely for everyone.
Great practical advice. And beyond moving day, what about those ongoing responsibilities? Insurance seems like a big one.
Definitely. You'll need to maintain homeowners insurance for the life of your mortgage. Your lender requires it. But more importantly, it protects you. Understand what your policy covers, usually the dwelling itself, other structures on the property, your personal belongings up to certain limits, and liability protection if someone gets injured on your property.
And what doesn't it usually cover?
Standard policies typically exclude things like damage from floods, earthquakes, sinkholes, and often normal wear and tear or lack of maintenance. You might meet separate policies or riders for flood or earthquake coverage, depending on where you live.
So understand your policy. Anything else long-term?
Yes, start building that home emergency fund we talked about way back at the beginning. Unexpected repairs will happen. Understand how your property taxes work and that they can go up over time. Learn the basics of home maintenance. It's a continuous learning process being a homeowner.
It really sounds like it. So, wrapping this all up, it's clear that becoming a homeowner is a huge undertaking, a really rewarding journey.
Absolutely. And while we've covered a lot of steps, a lot of information, the key takeaway is that with good preparation, understanding the process, and having the right guidance from professionals, it's absolutely achievable.
It really is navigable.
It truly is. You know, homeownership is so often framed as achieving the American dream. But maybe an interesting thought is, what if the true dream isn't just about owning the physical house, the roof over your head?
Go on.
What if it's also about the unique opportunity it gives you to become a real steward of your community? By putting down roots, you actually get to influence things: local schools, neighborhood safety, property values, community character, just by being an engaged resident and homeowner.
That's a really great thought to chew on. Investing not just in property, but in community.
Exactly.
Well, we really hope this deep dive has served as a valuable roadmap and reference for anyone considering that first home purchase.
Use this information, but also definitely consult with qualified real estate agents, mortgage lenders, and maybe even financial advisors to get personalized advice for your specific situation.
Get your questions answered, start those conversations, and take those steps to make your homeownership dream a reality.